Hey everybody, welcome back to 5 Minute Financial Markets. Another big green day on Friday. That's 6 in a row on the S&P 500, 6 green candles in a row. That does not happen very often. How much farther can this momentum carry this market? Well, in my opinion, not much farther. We've got a big brick wall we're heading towards. The Fed will be announcing their next rate hike, almost certainly a quarter point on Wednesday, and I think the market will sell off either just before that or if not, certainly immediately after that. Let's take a closer look at what's going on in these markets. So if we look at what happened during the day on Friday, and this is a 15-minute chart we're looking at, you see that we opened up, came back down, and from there just we're grinding higher throughout the day. But look at what happened at the end of the day. The last 15 minutes, we have this giant red candle that wiped out 40% of the gains from earlier in the day. And look at this volume. That is massive volume. About 30% of the total daily volume came in the last 15 minutes, which is not unusual. That's usually how days close out on big volume. But the fact that all this big volume came on such a big decisive move lower, that is a very bearish sign heading into Monday's open. And I think that's a sign of big money taking profits after this big run up, going back to the daily chart. All this last 6 days of upward movement. You see we had this upside down hammer candle on Friday where we went up and then closed back down. This type of candle is often the sign of a near-term top, and I will definitely not be surprised to see a big red candle on Monday. We could also bounce around a little bit. Again, we've got this meeting coming up on Wednesday that is certainly, or almost certainly, going to put a damper on the market. That's what the Fed has done all of the last year, if not more. Whenever the market's getting a little too bullish, the Fed comes out with hawkish language to cool things down. And whenever the market's getting a little too bearish, the Fed comes out with dovish language to try to prop it up a little bit. But it's not just the 15-minute candles and the Fed meeting that have me bearish on this market. Let's take a look at the smart money versus dumb money. And we've looked at this a few times in recent days, and this divergence is just getting bigger and bigger. This yellow line on the S&P 500 used to be coming in about here, and now it's going sharply higher, while the bond market is going sharply lower. As I've said before, when the stock market and the bond market are going different directions, the bond market usually has it right, and this negative divergence between the S&P 500 and the HYG, the high yield corporate bond market, is a very troubling sign for the near future for equities. Now, that said, there's a lot of FOMO and a lot of short squeezing driving this rally in the market right now, and those can last a lot longer than reasonable people would think that they should. Of course, there's the great quote by economist John Maynard Keynes that markets can remain irrational longer than you can remain solvent. That is absolutely true. So don't underestimate the power of FOMO and short squeezing to drive this market higher. But at some point, reality has to set in and this market will have to come back down and retrace some of these gains. Now, I mentioned the Fed meeting coming up on Wednesday, but that is far from the only big news item coming up in the near future. On Wednesday morning, 30 minutes after the market opens, 7 a.m. Pacific time, we've got the ISM Manufacturing PMI, which is an early indicator of inflation, and the JOLTS job openings number, which is an early indication of the strength of the jobs market. Then we've got the interest rate decision at 11 Pacific, followed by Jerome Powell's statement at 11:30. And another big news day on Friday with unemployment and non-farm payrolls coming in 1 hour before the market opens, 5:30 a.m. This is set up to be a very volatile week. And speaking of volatility, we take a look at the volatility index, the VIX, back down near the 52-week lows. And anytime it's gotten down anywhere near this area over the last 13, 14 months, we've had a big rip higher in volatility, which means a big move lower in equities. I definitely expect to see the SPY coming below this key 400 level, maybe all the way down to retest this yellow trend line. This, of course, this big yellow downward trend line is the one that has held this market down for over a year. We've talked about this many, many times before. This is where we sold off at the all-time highs last January, hit this line again in March, hit this line again in August, again in November and December, and then again several times over the last few weeks. Once the market breaks through a big resistance line like this, it is almost impossible for it not to come back and retest that line at some point. And I think that's what's coming this week. So I'm looking to see the markets get at least back down to 395, if not all the way down to the 390 level. We'll see what happens. Stay safe out there, practice good risk management, and if you enjoy this content, please hit like and subscribe. Thanks a lot, see you next time.